Hey there, fellow money-hungry moguls. Welcome to another exciting episode where we unravel the mysteries of the business world. Today, we're diving headfirst into the thrilling world of business combinations. Buckle up, because this is going to be a fascinating ride. Picture this: two companies, once independent entities, decide to become one. It's like a grand partnership where both parties bring something valuable to the table. That, my friends, is a business combination in a nutshell, but there's so much more to it than just a handshake and a merger announcement. Think of it as a corporate marriage with all its complexities, risks, and potential rewards. Just like in any relationship, there are highs and lows, but the goal is mutual growth and success. Now, why would companies even bother with this whole merging thing? What drives them to take such a significant step? Well, the reasons are as diverse as the companies themselves. Each merger or acquisition has its unique motivations and strategic goals. Sometimes it's about expanding market reach. Think of a tech giant gobbling up a promising startup. This allows the larger company to tap into new customer bases and markets. Other times it's about gaining access to new technologies or cutting costs through synergy. By combining resources, companies can innovate faster and operate more efficiently. Whatever the reason, business combinations are a big deal, folks. They can reshape industries and create new market leaders. Let's take a real-world example to solidify our understanding. This will help us see the practical implications of such strategic moves. Imagine a tech behemoth like, say, Tech Giant setting its sights on a nimble software developer called InnovateSoft. This isn't just a random decision, it's a calculated move. Tech Giant, with its vast resources, sees the innovative potential of InnovateSoft and decides to make a move. They recognize the value that InnovateSoft can bring to their existing operations. This, my friends, is a classic case of a business combination. It's a strategic decision aimed at long-term growth and market dominance. Tech Giant, the acquirer, sees value in absorbing InnovateSoft, the acquiree, into its fold. This isn't just about assets, it's about people, technology, and market presence. This could be due to InnovateSoft's cutting-edge software, a loyal customer base, or a team of brilliant minds. Each of these elements adds significant value to Tech Giant. Whatever the reason, this combination allows Tech Giant to strengthen its market position and gain a competitive edge. It's a strategic move that can redefine their future. Business combinations, when done right, can be a win-win for everyone involved. They pave the way for innovation, growth, and new opportunities. Now, let's talk about the elephant in the room, or should I say the dollar sign in the boardroom. You see, when companies decide to merge, they need to figure out how much each company is actually worth. That's where fair value comes into play. Fair value is like the price tag on a company, but instead of being a fixed number, it's a carefully calculated estimate of what a company would sell for in a fair and open market. Think of it as the price a willing buyer would pay a willing seller, both with all the necessary information and no pressure to close the deal. Determining fair value is crucial because it forms the foundation for the entire business combination. It's like laying the cornerstone of a skyscraper. Get it wrong, and the whole thing could come crashing down. To arrive at this magical number, financial wizards use a variety of valuation techniques. Some common methods include discounted cash flow analysis, which estimates future cash flows and discounts them back to their present value, and comparable company analysis, which compares the target company to similar publicly traded companies. These methods rely on financial data, market conditions, and a healthy dose of professional judgment. So, we've talked about business combinations and the importance of fair value. But what happens when the price a company pays for another company is higher than the fair value of its identifiable net assets? You guessed it, we enter the realm of goodwill. Goodwill is like the premium you pay for a company's reputation, brand recognition, customer loyalty, and other intangible assets that contribute to its value but aren't easily quantifiable on a balance sheet. It's the secret sauce, the X factor, the je ne sais quoi that makes a company worth more than the sum of its parts. Let's go back to our example of Tech Giant and InnovateSoft. Suppose Tech Giant agrees to pay a whopping $1 billion for InnovateSoft, but the fair value of InnovateSoft's identifiable net assets minus liabilities, is only $800 million. That means Tech Giant is paying a premium of $200 million, which is recognized as goodwill on the balance sheet. Now, goodwill isn't just some arbitrary number cooked up by accountants. It represents the future economic benefits that tech giant expects to realize from acquiring InnovateSoft's intangible assets. This could include things like InnovateSoft's strong brand name, its loyal customer base, or its talented workforce. Goodwill is a powerful concept, but it's not without its critics. Some argue that it's too subjective and prone to manipulation, while others point out that it can be difficult to measure and track over time. Critics often highlight that the valuation of goodwill can be influenced by management's optimistic projections, which may not always materialize as expected. Nevertheless, goodwill remains an integral part of business combinations and a testament to the value of intangible assets in today's knowledge-based economy. In fact, in many industries, intangible assets like intellectual property, brand equity, and human capital are becoming increasingly important drivers of value. Companies are investing heavily in these areas, recognizing that their future success depends on more than just physical assets and financial capital. As we move further into the digital age, the significance of intangible assets and goodwill is only expected to grow. Understanding and accurately valuing these elements will be crucial for businesses looking to thrive in a competitive landscape. So, the next time you hear about a major acquisition or merger, remember to look beyond the numbers and consider the intangible value drivers at play. These unseen factors can often be the key to unlocking a company's true potential and driving long-term success. And that, in essence, is the intangible value driver. Section 4. Accounting for Combinations, Unveiling the Numbers. In this section, we will explore the intricate details and processes involved in accounting for business combinations, a crucial aspect for any growing enterprise. Hold on to your hats because things are about to get technical, but don't worry, we'll break it down step by step. We're delving into the exciting world of accounting for business combinations. This is where the magic happens, transforming two separate entities into one cohesive financial unit. Don't worry, I'll guide you through the jargon and make it as painless as possible. By the end of this, you'll have a clear understanding of the key principles and practices. When a business combination occurs, the acquirer, in our case, tech giant, needs to prepare consolidated financial statements that combine the financial information of both companies as if they were a single entity. This process ensures transparency and accuracy in financial reporting. This involves identifying the acquirer, determining the acquisition date, and understanding the fair value of the acquired assets and assumed liabilities. Recognizing and measuring identifiable assets acquired and liabilities assumed, which is a meticulous process requiring precision and expertise. And recognizing goodwill or a gain from a bargain purchase. Goodwill represents the premium paid over the fair value of net identifiable assets, reflecting the future economic benefits. Let's break down the key accounting entries involved. First, recording the acquisition. This initial step sets the foundation for accurate financial integration. On the acquisition date, tech giant would debit the identifiable assets acquired and credit the liabilities assumed at their fair values. This ensures that the balance sheet reflects the true economic value of the acquired company. The excess of the purchase price over the fair value of identifiable net assets is recognized as goodwill. Next, depreciation and amortization. These are critical for understanding the long-term financial impact. Except for goodwill, which is not amortized but tested for impairment annually, ensuring it still holds its value, identifiable intangible assets with finite useful lives are amortized over their estimated useful lives. This systematic allocation of cost helps in accurate financial planning and reporting. Lastly, consolidation. Tech giant would consolidate InnovateSoft's financial statements with its own from the acquisition date onwards. This step is crucial for presenting a unified financial picture. These entries ensure that the consolidated financial statements accurately reflect the economic substance of the business combination. By following these steps, tech giant can provide stakeholders with a clear and comprehensive view of its financial health post-acquisition. Section 5. Challenges and implications, navigating the complexities. Business combinations, while potentially lucrative, are not without their fair share of challenges and implications. From due diligence and valuation to integration and cultural differences, companies need to navigate a minefield of potential pitfalls. One of the biggest challenges is accurately valuing the target company and assessing the potential synergies and risks involved. Getting this wrong can lead to overpaying for the acquisition or failing to realize the expected benefits. Integration is another major hurdle, as companies need to blend different corporate cultures, systems, and processes. Moreover, business combinations can have significant implications for stakeholders, including employees, customers, suppliers, and investors. Employees may face uncertainty about their jobs, while customers may experience changes in products or services. Navigating these challenges requires careful planning, effective communication, and a deep understanding of the intricacies of business combinations. By addressing these challenges head-on, companies can increase their chances of a successful and value-creating merger or acquisition. Section 6, Mastering Business Combinations, a recap. Congratulations, you've made it to the end of our whirlwind tour of business combinations. We've covered a lot of ground, from the basics of mergers and acquisitions to the complexities of fair value, goodwill, and accounting implications. Remember, business combinations are like high-stakes chess games. They require strategic thinking, careful planning, and a deep understanding of the players involved. By mastering these concepts, you'll be well equipped to navigate the world of mergers and acquisitions and make informed decisions that can drive growth and create value. So keep those brains buzzing, stay informed, and remember, in the world of business, knowledge is power.